Hey, welcome to The Explainer. So we all know that we should be investing, right? To beat inflation and build for the future. But the big question is always, how? How do you actually do it without it turning into this stressful, all-consuming, full-time job? Well, today we're going to explore a surprisingly simple and, even boring way to build real wealth.
You know, when someone says the word investor, I bet this is the picture that pops into your head, right? Some guy in a suit, glued to a screen, trying to hunt down that one magic stock that's going to make him a millionaire. But let's be real for a second. For most of us, that's not an investing strategy. That's basically just buying a lottery ticket.
But what if I told you there's another way? A path that doesn't require a crystal ball or spending hours staring at complicated charts. What if the real secret to winning and investing is actually to be a little bit lazy? All right, so here's our game plan. We're going to kick things off by talking about the biggest mistake that trips up most investors. Then, I'll introduce you to this incredibly simple tool that basically lets you buy everything. We'll also uncover this sneaky little fee trap that can absolutely destroy your profits if you're not careful. After that, the fun part. We'll build a sample portfolio step by step. We'll even look at a 20-year story of two investors to see how this all plays out in the real world. And finally, we'll wrap up with a super simple pre-flight checklist so you know exactly what to do. Okay, let's dive right in. First section, we're going to unpack the single biggest myth in the world of investing, and believe me, falling for it can be a very costly mistake.
So when it comes down to it, you've really got two main philosophies. Over here on the left, you've got active investing. This is that high-stress world we just talked about, trying to be a genius, picking individual stocks, and hoping you get it right. It's a lot of work. And then on the right, you have passive investing, and it is the complete opposite. You don't try to pick winners at all. Instead, you just buy a tiny piece of the entire market and let time do the heavy lifting for you.
So how on earth do you buy the entire market? Sounds kind of complicated, right? Well, it's actually super simple, thanks to two brilliant inventions that completely changed the game for regular people. Okay, first up is this thing called an index. The easiest way to think about it is like a scoreboard for the economy. The most famous one is the S&P 500. It just tracks the performance of the 500 biggest companies in the US. You know, your Apples, your Microsofts, the big guys. And historically, this group has returned about 10% a year on average. But here's the catch. An index is just a list, it's a concept. You can't just go out and buy the S&P 500.
Well, that's where our hero comes in, the ETF, or Exchange Traded Fund. This solves the problem perfectly. Imagine a big shopping basket. A fund manager goes out and buys a little piece of all 500 of those companies from the S&P 500 index. Then they bundle it all together into one single thing, one share that you can buy with just one click. So in an instant, you own a tiny slice of the whole American economy. It's genius.
Okay, so if ETFs are this simple and this powerful, you're probably thinking, why isn't my bank screaming about these from the rooftops? And the answer, my friends, comes down to one simple, not-so-sexy word: fees. Just take a look at this. It says it all. On the left, you've got your typical mutual fund that a bank might try to sell you. They might charge, say, a 2% annual fee. Doesn't sound like a lot, does it? But then you look at the ETF on the right. It does pretty much the exact same thing for a fee of 0.2%. That's not a small difference. It's 10 times cheaper. Huge. And here's why that tiny difference is an absolute game changer. Over 30 years, that small 2% fee can eat up 40% of your total profits. Just let that sink in for a second. Nearly half of the money that should have been yours goes straight to the bank instead. This is why keeping your costs as low as humanly possible is one of the golden rules of investing. All right, enough with the theory. Let's get our hands dirty. It's time for the practical stuff. What exactly should you buy, and how do you put it all together into a real portfolio? Okay, before we start picking our ETFs, there's one little detail we need to cover. The companies you own will pay out profits to their shareholders. These are called dividends. Now in Europe, you can get something called an accumulating ETF. This is awesome because it automatically reinvests those dividends for you, buying more shares and helping your investment compound even faster. In the US, it's a bit different. The dividends get paid out to you as cash. But no worries, you can just flick a switch in your brokerage account called DRIP, and it does the exact same thing. It tells your broker to instantly use that cash to buy more shares. So either way, the goal is the same. Get your profits working for you immediately. So where do you start? Well, a fantastic core for any portfolio is an S&P 500 ETF.
The advantage? You get that awesome historical growth from America's top 500 companies. The risk, of course, is pretty obvious. All your eggs are in one basket, the US economy. And to find these funds, you use what's called a ticker. It's like a stock symbol. For folks in Europe, a popular one is CSPX. If you're in the US, you'll be looking for IVV.
Now, if you're thinking, I'm not sure I want to bet everything on the US, then an all-world ETF is your best friend. This is maximum diversification. We're talking about buying into over 1,500 companies across more than 20 different countries. Now, historically, its return has been a tiny bit lower than a pure S&P 500 fund, but you're spreading your risk all over the globe, which is a huge plus. The tickers you're looking for are VWRA in Europe and VT in the US.
Okay, what if you want to add a little more spice, a bit more growth potential? That's where something like a NASDAQ 100 ETF can come in. This one focuses only on the 100 biggest tech companies in the US. So yes, it's a higher risk because you're concentrating everything in one single sector. But that also means it has the potential for much higher rewards. For this one, you'll want to look for CNDX in Europe or the very famous QQQ in the United States.
And for our last piece of the puzzle, to really diversify your holdings, you could add something called a small cap value ETF. Don't let the name scare you. Cap just means company size. So this fund is investing in over 1,600 times smaller US companies that the market might be overlooking. It's a great way to balance out all those giant companies that dominate the other indexes. The tickers here are ZIPROV for Europe and AVUV for the US.
And you know what? Putting this all together is so much easier than you think. First step, choose a good low-cost broker. A lot of them have this great feature, sometimes they call it a pie or just a portfolio, that lets you automate everything. You just search for the ETFs using those tickers we talked about, add them to your pie, and then you decide the percentages. Like, I want 40% in this one, 30% in that one, and so on. But the last step is the most important one. Set up a recurring automatic investment. Every week, every month, whatever works for you. Just set it and forget it.
So here's just one example of what a pie could look like. You could put a solid 40% into the all-world ETF as your global foundation. Then maybe 30% in the S&P 500 for that strong US growth. You could add 20% in small cap value to diversify away from the giants, and then maybe a 10% slice for the NASDAQ 100 to give it a little tech-focused growth kick. But remember, this is just an example. The beauty is that you get to decide your own recipe.
Okay, so this whole boring, automated strategy sounds good in theory, but does it actually hold up in the real world? You know, with all the market crashes and craziness? Well, let's find out. Let's follow the story of two investors over 20 years. We'll call them Active Peter and Passive Anna. All right, so they both start out with 10 grand back in 2004. Peter decides he's going to be a stock-picking genius. Anna sets up her simple, automated ETF plan. Then, 2008 happens. The global financial crisis. The market is in a free fall. What does Peter do? He panics. He sells everything, locking in massive losses. And Anna? She does nothing. Her auto invest just keeps chugging along, buying up more shares every single month at these new, super cheap prices. Fast forward to the COVID crash in 2020, it's the same story all over again. Peter is frozen, scared to make a move. Anna's automated plan, it's just doing its thing, snapping up stocks while they're on sale. And after 20 years, well, the results are just jaw-dropping. Peter, with all his frantic buying and selling and high fees, managed to get an average return of just 3.5%. He barely beat inflation. But Anna, who basically did nothing but stick to her boring, low-cost plan, she captured the market's average 10% return. And her final wealth, it was more than triple what Peter ended up with. That's not a typo, it's not magic, it is simply the raw, unbelievable power of compounding.
All right, so before you run off and get started, let's quickly run through a pre-flight checklist. Just a few simple rules to make sure you're picking top-quality, reliable ETFs.
Here are 3 big things to look out for. Call them red flags to avoid. First, try to avoid really small funds. Look for ones that have at least a couple $100 million under management. Second, you want a fund with a proven track record, right? So pick ones that have been around for at least 3 to 5 years. And third, stick with the big, reputable providers. You know the names: Vanguard, iShares, SPDR. These are the giants for a reason. And a little pro tip, especially for our European viewers, the website justetf.com is an absolutely fantastic resource for checking all these details. So there you have it, the simple, powerful, and, okay, yeah, maybe a little boring way to invest. It's not about finding a lottery ticket. It's about a reliable, proven path to building real wealth over time. You've seen how it works. The only real question left is, What could 20 years of boring investing do for your future?